Hi, everyone. This is Rohit from Austrian, and I'm excited to have Melissa Widner, who's the CEO of Lighter Capital, the pioneer and leading provider of revenue-based financing to SaaS companies. Melissa was the managing director of NAB Ventures, the VC arm of National and Australia Bank, and a general partner at Seattle-based SeaPoint Ventures. She's the founder and CEO of Seven Software, a Silicon Valley-based enterprise software company which was acquired by Concur. And she was also the CEO of Northwest Industrial Supply. She's on a master's in education from Stanford. Welcome to the show, Melissa.
Hi, Rohit. It's great to be here.
Awesome, Melissa. You have a great experience. You founded your own company, and now you are the CEO of Lighter Capital. Now, how did you get into this crazy world of startups, and what led you to be the CEO of Lighter Capital?
Well, people come to startups in a lot of different ways, but I was probably had a typical path in that I was a pretty entrepreneurial kid. So I was starting businesses when I was younger, and I had a business when I was in college. So I was always quite entrepreneurial. And that led me to, right after school, a friend of mine's father hired me to run a company of his that was a turnaround. And then I went to business school and did a little bit of time in banking, but started a software company called Seven Software in Silicon Valley. And that had a successful exit to Concur. Then I went into venture capital in the US, and then landed in Australia with an Australian husband, and ended up running National Australia Bank's venture capital fund. And that is what led me to Lighter. So in 2018, National Australia Bank, along with Silicon Valley Bank, invested in a round for Lighter, a funding round for Lighter, and I went on their board. And I absolutely love the company and love what they do. As an entrepreneur, an angel investor, and a venture capitalist, I really understood the value proposition. And when we needed to bring a new CEO in 2020, I applied for the job and I got it. So I've been at it for a couple of years now.
Super interesting. And you have been part of NAB Ventures as well as SeaPoint Ventures. Did a stint in a VC firm really help you become a better operator, since you are a CEO at Lighter Capital?
Yeah, I love that question, because I was the CEO of two companies that both had really successful exits. And when I look back on, I was young at that, and for both of those roles, I really didn't know much about running a company. So I think a lot of the successful exits had to do with luck and timing and really good teams. But then I went into venture and had the great fortune of working with amazing CEOs, seeing good CEOs and bad CEOs and really getting to see a lot of different management styles. And I think I was in venture for almost 2 decades, and I always had in the back of my head that I'd love to get back into an operating role and see if I could apply some of these learnings that I've gotten from watching these CEOs I've worked with as a venture capitalist. So I actually think it's a great way to get a broad view of different management styles, and it's really a privilege.
Got it. And I want to talk about a Lighter Capital. Is it revenue-based financing only to SaaS companies, and which are the sort of companies that you help across?
It's primarily been SaaS, but it's any company with recurring revenue. So we have some B2C, we have some services companies. Historically, Lighter Capital was really the original player, is the original player in this space to do this SaaS lending at scale. We started in 2010 and really started focusing on SaaS in 2012. And we've done about 1,000 rounds of financing since then to close to 500 companies, and most of them are SaaS companies. But it's really any company with at least 15,000 in monthly recurring revenue, we would look at to potentially fund.
Got it. Interesting. And around 50 to 80% of the ad spends goes into Facebook and Google ads. Especially when you're building a new company, you got to put a lot of money into ad spends. But why is that? And what do you think would be a solution around that?
Around ad spend?
Yeah, especially when it comes to B2C and B2B, SaaS companies, a lot of money is being put into ad spends, and most of the new acquisition of customers happens on Google and Facebook. But is there any turnaround? What can companies do to have a better acquisition channel?
Well, it's really company specific. So it's a question that you'd have to look at the specific company. I think on the consumer side, probably that's the main path. On the B2B side, a lot of times it could be partnership or the influencers in the space talking about your product. So it depends on the business itself. But you're right that ad spend is something people rely on a lot more than they did, say, a decade or 2 decades ago for customer acquisition. And I think given that, it's important to have tools to make sure that you're tracking, what's actually producing the most for your spend. And there's a lot of great tools out there.
Got it. And before the call, I was talking about how I worked on a bit of revenue-based financing, and
Yeah.
I just wanted to understand, especially when it comes to B2B SaaS companies, how can debt financing help them? Which are the companies who should look at debt financing rather than liquidating the stake, the equity stake?
So if you are a company, a growth company, and you need a certain amount of money to get to the next stage, and you can get that money in debt or equity, so say it's the same amount of money, let's call it $1 million, and you have the opportunity to get that $1 million in either debt or equity, you should always take debt, unless you're going to get something more with the equity. For example, if you're going to bring on an equity partner that's really going to move the needle on your business because they're able to introduce you to partnerships or do something else that really, if you're giving them 10, 20% of your company, that's actually going to bring more than that in value for the company. Or unless the debt is going to be burdensome to service and potentially put the company at risk. So, but if you have debt that's not burdensome to service, and if you are not going to get enough value from the equity provider to justify the control sometimes and the equity you're giving away, you should always take debt over equity. And I know you know this better than anyone, given you did your thesis on revenue-based financing. But with revenue-based financing, the nice thing about it is that, at least the way Lighter does this, not all companies do this, but our revenue-based financing product, we collect a fixed percentage of the revenue. It's usually under 10%. So call it maybe 6 or 7% of the revenue that's set in advance when we provide the funding, and it's on a monthly basis, and it's based on cash collected revenue. So the company's not in a situation where they can't pay, because if their revenue declined, then the amount they pay declines. And we saw that in COVID. We had companies in the event space whose revenues went down 90%. We had a company that did corporate lunch delivery, and their revenue was down close to 90%. That, as you can imagine, when COVID hit, that business all but stopped. But they didn't have an onerous debt burden to service, because the amount that they paid was a percentage of the revenue.
Very interesting. And when it comes to processing loans to startup founders, what metrics are important for you, and how long does the entire process take?
So if you're a slow typer, it takes 10 minutes to fill out our application, and then usually a term sheet. It depends. If it's really straightforward, if there's no questions, a term sheet can be in a day or two, and the funding can happen in a couple weeks. So compared to going out for a venture round that, you have lots and lots of conversations, sometimes dozens, sometimes more than 100, and could take months, maybe even more than a year to get funding. It's a really fast it's a fast and a straightforward process. because there's not, at least in our decision making, it's almost 100% objective.
Right.
Where when I was on the venture side, the thing that the thing we were looking at the most was team, and team is very much a subjective measurement versus revenue based. Our financing is objective. Our decision making is based on objective criteria.
Got it, interesting. And do you think revenue-based financing is like an alternative to VC funding? And do you think VC funding is up for disruption?
No, it works in tandem. And look, if you are a company, if you're running a company that needs lots of money and going, for a very big market, you're probably going to have to go down the VC path. We provide up to 4 times monthly recurring revenue to companies with under 3 million in revenue, and up to 6 times monthly recurring revenue to companies with over 3 million in revenue. So when you think about that size, let's say a company is doing 50,000 a month in revenue, we could give them $200,000 in funding. And that's great. That maybe allows them to hire a couple more salespeople or a couple dev. But if you're a company at that stage and you need to raise 10 million to go, to get it to the next level, then you'd have to go down the venture path. And we have, like I said, we've done close to 1,000 rounds of financing. So we have a lot of different paths that our customers take. Some never take VC financing, and some never take it because they just do not want anyone on their cap table. They want to run their company. They don't want, they don't want to give up any control. Some don't take VC financing because they won't qualify for it, simply because their TAM isn't large enough. So their total addressable market's not going to be large enough. VCs are primarily unicorn hunters, and they're looking for really large companies. There's a lot of great companies that aren't going to become unicorns that are still, nice growth companies and need growth funding. And then we have several examples of companies in our portfolio that used our capital to get them to a point where they were VC ready. And we have companies that use us, especially these days, for in-between VC rounds. So they've raised some VC money. They aren't ready to go out for another round for whatever reason. Maybe they're just about to hit a big growth spurt and they want to wait until they, achieve that before they go out and set a new valuation. So they'll use us for in-between VC rounds.
Got it. And you talked about COVID, but do you think because of COVID, it has led to a disruption where the VC investing for a long time was happening only in the important hubs and cities? But do you think for lighter capital and for other VCs, do you think big companies can come out of smaller hubs and smaller cities around the world?
Yeah. One of our former portfolio companies, because they paid us off, which is what happens with most of our companies, is one that was out of Ohio, Seamless AI, and now they're a unicorn, amazing company, and a great product. We use their product. But they, Brandon and Danielle, the founders, talk about how, when they first started, they couldn't get VC funding because they were told, you can't start a tech company in Ohio. You're not going to get funded with running a company in Ohio. And I think that's all gone by the wayside now because, we see this remote work works, and we're seeing these hubs really take off. So, and COVID was an accelerator. I think that was probably happening anyway, but COVID really accelerated it.
Yeah, you're absolutely right. I think COVID really accelerated it, and especially when it comes to lighter capital, how does lighter capital make their revenues, and how do you look at unit economics, especially when a startup is just making $15,000 in MRR and you're looking to fund them?
Yeah, so the way that we make our money is we have a cost of capital, and our capital source is from Credit Suisse, and we have a warehouse facility with them, and we pay them a fixed amount for that capital, and we lend that capital out with our revenue-based financing, and we make our money on the margin. So we are aiming to make, we don't have a set interest rate. Well, back, we do actually have term loans for companies that want just a fixed loan. Most companies want the revenue-based financing, which is where the amount they pay fluctuates with their revenue. At the end of the day, they pay the same amount. If they're going to pay us, $1.30, they'll pay us $1.30. It's just the timing on that could be 3 years, or it could be, 2 years, depending on how quickly they grow. But we are aiming to, make a higher IRR than we're actually paying our revenue, our facility, our credit facility. So that's how we make our money, is on the spread.
Got it. And since you're working with hundreds of founders, how do you look at building trust with the founders? Since it's an exchange of money, as well as building trust over time, and they also look at topping up capital. What's the best way to build a trust with the founders?
Well, the process is so straightforward. We are plugged into their financials. They are paying us a percentage of their revenue until the loan is paid off. So I think, I had the good fortune, just in terms of coming into Lighter. Lighter has such a great reputation in the market, because from the get-go, they've always just been a company that has really appreciated the entrepreneur's journey, understood the entrepreneur's journey, and been supportive of entrepreneurs. And so that reputation was built up over a long time. So when companies come in, they usually know other companies who've worked with us before, and we have a great reputation for being good to work with.
Got it. And Melissa, you've been part of a few VC firms as well as companies which you founded earlier. What advice would you give to founders on how to structure their raise?
Well, it's depends on what you're hoping to do. Like we talked about earlier, if you need to raise a lot of capital to get to the next stage, then you would have to go down the VC route, and you really want to find a VC who supports your vision. And that's the most important thing, to make sure you're aligned there. And when you get multiple VCs, which I think is actually, if you are going down the VC path, it's a good idea to have more than one. You want to make sure they're aligned too. I started my VC career in the 2000s, and that was a tough time. We had the tech wreck and then the GFC. What could make things quite difficult is when you had funds that had different timelines. You might have a VC on your board that wants an exit quickly because they're at the end of their last fund and they're not raising another fund, and a VC who's at the beginning of a new fund and wants to really push the company to become large, and that can be really stressful and confusing for the entrepreneur when you've got your sources of capital who you have to listen to if you're going to need more capital, and they at that point probably have some control over the company. When you have different board members and different stakeholders pushing you in different directions. So I would make sure when you're bringing on capital providers, and especially onto your board, that they're aligned with your vision. And that's an easy advice to give, but I always would laugh when I got that advice as an entrepreneur, because you get the advice, choose your VCs wisely, when the reality is most entrepreneurs don't have a choice. The VCs only fund 1% of companies they look at. We like to celebrate the companies that had 10 term sheets and got to choose the one, but the reality is most companies that get funded don't have a multiple of term sheets that they're choosing from. So it's great advice to tell an entrepreneur to choose your VC wisely, but a lot of times they're not even in a situation where they have a choice.
That makes sense. And do you think a founder should always be raising?
I remember when I was running 7 Software, and one of our early advisors said to me, I remember saying, "Oh, I hate fundraising. I don't know anyone that likes fundraising, but I hate fundraising. I can't wait till this is done so I can get back to my job of running the business." And he said, "Melissa, your job is fundraising. You should plan on spending 1/3 of it fundraising, whether you're in a fund, whether you're in a fundraise or not. You're spending time nurturing your current investors, prepping potential future investors. So if you are a company that's going to require a lot of capital over multiple rounds, you should always be fundraising, even if you're not in the middle of the fundraise. But when I look at a lot of lighter capital, a lot of our portfolio are capital efficient companies, and they have the luxury of not having to do that. And when they do, if they take capital from us, like I said, the application is 10 minutes if you're a slow typer. It can be as little as a few weeks until the money's in your bank, a couple days until you have a term sheet, and it doesn't take a lot of the entrepreneur's time.
Obviously revenue-based financing could be a great option, but what advice would you give to founders who are looking to raise funds during these times?
To raise venture financing or any financing?
Yeah, any financing, especially during times of recession.
Yeah, well, this is a tough time to raise.
Yeah.
It's a tough time to raise, especially if you raised a year ago or 2 years ago or any time before 6 months ago, because valuations are down. Valuations have been going up and up and up for quite a long time. We've been in a bull market since 2009, as you know, until recently. So you just have to be prepared probably for a down or a flat round, even if you've done well. And that's tough. It's tough for, venture capitalists. They don't like to write down their investments, especially if they're in the middle of raising a fund. It can make it difficult to explain to employees that potentially their options are underwater right now if you raise at a lower round. I mean, revenue-based financing is actually a great option in a market like this, because for companies who did a financing round last year and then have done well, and we're planning on doing one this year because they need more growth capital, this is an option for companies that not only don't want to take dilution, but also don't want to price around.
Got it. And I want to talk about hiring, especially when you're looking to scale a business. You're always looking for high performers. But what does high performance really mean to you in business? Especially since you built Zen Software and you've been a CEO of Lighter Capital.
Well, the team is so important. I mean, that's just that sort of goes without saying. And what the best way, I think, to find a high performer is, to find people that who they've worked with before. So when I came to NAB, or to Lighter Capital from NAB, I brought our COO, Nick Baker, who I worked with at NAB for a couple of years. So I knew exactly what he was like to work with. I knew he was a high performer. Looking at Lighter as we hire people and bring other people in, a lot of times it's from somebody that we know or someone that they've worked with. And that gets hard. It gets hard to do if you have companies that are hiring hundreds of people in, a short period of time. You're not going to have all of those connections, but to the extent that you can find out, what they're like to work with from other people they worked with. I'm still surprised. I was so surprised how often people don't do the proper reference checking before hiring people. And one thing, another mistake I saw all the time as a VC, and I saw VCs pushing companies to just, hire quickly. And hiring quickly is great because you need people to execute. But if you make the wrong decision in hiring quickly, then it just ends up taking a lot more time than it would have if you had taken a little more time to make the right hire.
Got it. Interesting. And especially, with your experience as a VC, what do you think do the best companies do to retain talent, especially when they're looking at scaling up? Because a lot of companies look at scaling up and they really hire a lot of people, but the culture is cannot always be maintained, especially when it goes from Series B to D, when you're really scaling up and you're putting a lot of growth capital. What do you think the best companies do to retain such talent?
I think that respect for your team members and understanding what the team members, what's important to them, and communication. I mean, I can't say that enough, but, sometimes at the leadership level, you're thinking about and talking about the strategy all the time. So you assume, other people understand what it is because you've maybe said it, months ago at the last quarterly meeting, but it's something that's important to reiterate all the time in the direction, so everybody understands where you're going. And we did some things early on when I came on at Lighter on the culture side that I think have worked well. First of all, Lighter was, prior to COVID, it was not a remote company at all. In fact, they would hire people to manage the New York office, or to manage the New York market, and require that they live in Seattle. So it was very much a, pre-COVID way of working where everybody had to be in the same office together every day. And now after COVID, we went fully remote, and we have people in, I think, 7 different countries all over the US. And that's working really well, but we put a lot of time and thought into what it means to run a remote company and how we keep that connectivity going even when we're remote. So we do a couple offsites where we get together in person, and it's really fun, and it's more about those offsites. While there is some business, and some that's conducted at those offsites, for the most part, it's really about, how do we form those bonds and do that accelerated water cooler talk, and so far that's working really well. One thing I noticed when I came into Lighter had a policy, like a lot of startups do in the US, of unlimited vacation. And I remember coming in, I'd been in Australia for a while, where in Australia, everyone has 4 weeks and everybody takes it. And a lot of people even take more than that, probably because it takes like that long just to leave Australia and come back. But I thought, well, that's a really generous policy. And then I came in and I saw that people weren't really taking vacation. And, it's so important to get away, to get that downtime. And, it's really important, not just for the person, but actually for the company, to have people that are refreshed and get that time away. So what we did is we started providing an incentive to our employees to take vacation. And we said, if you take a week and you don't respond to email during that week, then you'll get a $500 bonus. And if you respond to email, you don't get the bonus. So we really try to push, how important that is to, to do that. And I think that, it's something that we really live by. We celebrate it when people take vacations.
Yeah, no, I absolutely love that. And Melissa, you've been a successful VC, and you are a CEO for a fast-growing startup. What do you think the startup ecosystem should do to have a level playing field for female founders as well as VCs, so that we have more representation of them?
Well, we're seeing great strides there. So I co-founded an organization in Australia called Heads Over Heels in 2010 that supports female entrepreneurs running high growth companies. And we've seen the numbers move in terms of women in Australia, especially running companies and starting companies that are getting funded. There's still pretty dismal numbers in terms of overall dollars that go to women-led companies, on overall VC dollars that go to women-led companies. And that is partly, so that's a negative story that's out there. But on the positive side, we're seeing more women get funded. It's just, you still have that small percentage because a lot of the companies that are getting lots of funding are run by men. But we're starting to see that change, which is nice. It's taking a long time. And we're also starting to see more women in investing and at venture firms. I just hosted an event at my house in Seattle for women in VC. And I think we had 20 people there, which was great. And if I had done that in Seattle, when I was a VC in Seattle in the 2000s, I think we would have had 3 or 4. So that's changing. We still don't have a lot of women at the partner level, but there's a lot of women. I'm encouraged to see a lot of women at the associate level and the analyst level. So, we should see some changes in a few years. And that's really changed a lot in the last decade. And as we see more, not just women, but people of color and people who aren't, your traditional, what was typically a VC, a white male, as we see that, we will see we will see a diversity in funding as well, and who the funding goes to.
Got it. And I quickly want to do the top 3. What's your favorite business book?
Oh, so I love Built to Last. It's one that I've probably read 3 different times over the last 2 decades. So that's one that I go back to when I just need a little refresher. And the hard thing about hard things, it's an easy read. It's encouraging. It's sort of a pep talk when you need it. And on the culture side, I like No Rules Rules, which is the Netflix, how Netflix built their culture. That's I don't necessarily agree with everything in there, but it's very thought provoking. So those are 3 of my go-tos.
Got it. We'll put that in the show notes. And if you could go back in time when you started working with Lighter Capital, what is the one thing you would have focused on or done anything different?
So I wasn't the founder of Lighter.
Right.
I came in a couple years ago as the CEO. So it's probably not as relevant a question for me. If I go back to 7 Software and think of what I would focus on, we did a lot of things really right in terms of we got a really good team on early. We got great people. And when I think about that company and the success of that company, it had to do with, which is kind of obvious, but we really had a phenomenal team. And a lot of them have gone on to do, and we were all pretty young at the time, but have gone on to do some pretty amazing things.
Got it. And what's your favorite online tools, example, Gmail, Slack, Zoom?
Favorite online tool for business?
Yeah, for business or personally, do you suggest any online tool?
Well, we're a big Slack user, and we became a much bigger Slack user when we went remote or during COVID. So that works really well. We're a big Salesforce user, probably some of the obvious ones. Look, Calendly or any scheduling, why did that take so long? That just saves so much time. But so that's an incredible online tool as well.
Got it. We'll put that in the show notes. Melissa, what is the best way people can reach out to you and know more about Lighter Capital?
LinkedIn, so Melissa Widner, melissa@lightercapital.com. And if you're looking for financing for your company, we provide financing of anywhere between $50,000 up to $4 million for companies that have at least $15,000 in monthly recurring revenue. There's a pre-qual app that takes like 45 seconds to see if you might qualify. That's just lightercapital.com/apply. So I would encourage you to come and look and see if we're an option.
We'll put that in the show notes. Melissa, thank you so much for taking our time. I really enjoyed my conversation with you.
Thank you, Rahit. And I'm looking forward to reading your thesis on revenue-based financing.
Yeah, no, absolutely. I'll definitely share it. Thank you.
Thank you.